Do you understand what your business is worth and why? Today we're going to cover that, and also at the end cover what you do with any excess cash you might have in your business. This series is meant to help business owners that are thinking about selling their business. What we found is the people that are new to selling businesses don't understand the process and don't understand how to engage with advisors and basic things like how much the business is worth. And so we created this series to help with that. The first thing to understand is that most businesses are sold based on their future profit. This is something people a lot of times don't get. They talk about their business value being the fact they've been around for 30 years or they have gold plating on their windows or something like that. And when in actual fact, businesses are like a sausage machine, and the sausage is profit, and what someone's really doing is buying your future profit. Okay, it sounds a bit clinical. It isn't, because the other thing they're also buying is the people that generate that profit, and then there's a huge cultural fit and heart aspect and carrying on your vision and all that comes into it. But when it comes to a valuation aspect, unfortunately, we're in the math zone. And so we have to understand how the math mechanics work. In another video, we're covering the heart zone and actually getting the right person and taking care of your staff and vision and all that kind of stuff. So it's all part and parcel. But today we're covering the math aspect. So the first thing to understand is that you have two kinds of business sales. One is an asset sale, or you're selling your cash flow. So generally, we're selling the future value of the cash flow. If we're selling the assets, it's normally because the assets can't produce enough future cash flow to be more worth it than the assets. If you think about it this way, if you have a cow, you can have the milk on an ongoing basis, which is an analogy for the profit, or you can kill the cow and have steaks, but there's no more milk. Okay, so most businesses were actually selling the future cash flow. And so therefore, it all becomes about how we maximize that future cash flow. And also, because someone in a business sale is buying your future cash flow, there's a risk element that goes into it, because they're going to question how sure are we that is going to come in. Okay, so basically, the most pure way of valuing a business is in something we call a net cash flow method, or a net present value method. Now, it's the last time hopefully you'll ever have to hear about this, because if you haven't been to a business valuation training course or in the profession, we don't use it. It's too hard to manage, but it helps people understand the basis. Basically, we would take your future cash flows, and it would be, generally we use something called EBITDA, which is earnings before income tax, depreciation, and amortization. EBITDA is really just your operating profit with non-cash things and non-operational items added back. So you would take your operating profit and you would add things back like depreciation, any interest you're paying on long-term debt, like funding circle loans and things like that. So that's the net cash flow, or the net present value method. And you'll never have to hear about this again. Hopefully, it's something we use if you've been to a business valuation course or if you're in the profession. But I like to explain it to people because you understand the basis of valuation. Basically, your business is a sausage machine that's producing these lovely profits in the future. And what someone's doing is buying your future sausage, your future profit. And so in the net present value method, what we're doing is taking that after-tax cash flow, the cash flow the business is producing, and we are making adjustments for things that were one-offs or personal to you, because that will not be the situation for the buyer, right? So if you have cars or holidays or things like that, or one-offs like you had a fire or something like that, we're going to add that back, because that's not going to happen again, especially after someone buys the company. They're not going to have the same car. They're not going to put holidays to the business in the same way. So we have a nice, lovely cash flow that's coming out of the business after tax for this particular calculation into the future for the buyer. And that's what he's buying. And then what we're going to do is we're going to use an expected rate of return and create what the net present value of that number is. If you think about a home loan, the bank is willing to give you £500,000 today if you will make a £1,500 payment, maybe it's a bit more with the interest rates, over the next 30 years. And they calculate that $1,500 over 30 years, they do a net present value calculation based on maybe a 6% interest rate to give you a present value of £500,000 today. It's similar to that. And so the reason I explain this is so you really get the idea that valuation has a mathematical foundation. Now, because that's too complicated, we use these lovely things that if you've done business valuation training are a bit crude, but everybody uses them, so we need to get comfortable, called multiples. And if you've ever been anywhere near a business sales situation, people talk about multiples. Many people don't understand multiples, but we're going to go through that today. So there's two parts to the equation if we're using multiple. One is we have to have the actual profits that the business is producing. Now, when we're using a multiples method, we don't use that after-tax cash flow. We use a cash flow called EBITDA, earnings before interest, taxes, depreciation, and amortization. If you don't know what that is, just take your operating profit on your profit and loss, and we're going to add back non-cash items like depreciation, amortization, and things like that. We're also going to add back any interest that you've paid on long-term loans to try and proxy what the cash flow is in the business. We're also going to adjust that EBITDA to get a number we called adjusted EBITDA or normalized EBITDA for things that were one-offs or personal to you. We call them Hawaiian holidays and Ferraris. So if you're doing your holidays to the business, your cars, some people, my clients have built a house and put it through the profit and loss. It doesn't matter, because we want to add that back because we want to show what the real profit is going to be to a buyer in the first 12 months they own the business. If you want to think about it that way, it's not quite mathematically like that, but that gives you the visualization. We want to see what rate of sausage is this business producing to give us this lovely adjusted EBITDA or normalized EBITDA number. Then what we're going to do is we're going to apply a multiple. Now, multiples are a bit crude, but everybody uses them. And basically they go up and down with risk. Just keep that in your mind. It's not rocket science. They go up and down with risk. We also have data that shows us what multiples business sold for in certain sectors at certain EBITDA levels. Now, what drives a multiple up or down? So I have this lovely adjusted EBITDA number times a multiple. Where do I get my multiples from? Well, there's a few things that impact that. And one is how high your EBITDA is. So the higher the EBITDA, the higher the profit, the less risk. So multiples go up and down with risk. So if I have an EBITDA of 2 million and the same business has an EBITDA of 200,000, you can tell the one with 2 million is far less risky. It's like a big airplane being buffeted in the turbulence. The smaller plane gets a lot more buffeted. So what happens is as you go up to 1 million, for example, if you look at the data, we're seeing a 3 or 4 multiple, or things on the high street at a 2 multiple, things like that. I'm just throwing out just general things, but it gives you a flavor. When you go over 1 million, that same business might attract a 5 multiple. When you go over 1.5 million EBITDA, you get into your 6s and things like that. Again, there's a lot of factors that go into this, but that just gives you a flavor. Now you might ask, okay, my business is at 600,000 EBITDA. What's the difference between a 3 and a 4 multiple? Why would I get a 3 versus a 4? There are a few factors here. One of the biggest ones is quality of earnings. What that means is I'm buying your future sausage, your future profit, and I'm giving you all that money so that you can go hit the beach, which is what a business sale is all about. You can leave. But what are the chances that revenue isn't going to come in? So what is the quality of it? So if you have businesses with high recurring revenue, lots of contracts and things like that, the multiple is going to go up because I have less risk. If you have a business that requires a lot of contracts and requires a new one every time, that's more at risk because I might not be able to get those contracts. Another thing that affects risk, again multiples, is the customer concentration. So if all of my revenue is half of my revenue was with one customer, that's very risky. And because if that customer went away, it would basically, collapse my profit. We'd much rather see the biggest customer being 10%, for example, and that lowers what we call customer concentration risk. Another risk is what we call key person risk. Whereas if you have a person in the business, remember you have the sausage machine, which is mostly people in most businesses. And one of the biggest issues we have is the person selling, the owner, is leaving. What's the impact on that machine's ability to function? And what we find is a lot of owners have what we call X factor leadership qualities. Remember, they've been able to navigate this business through its ups and its downs and changes and all that. They may have a good management team, but management and leadership are different. And so it's what's the impact going to be if we pull them out? And also it's a function of the type of buyer that's coming along. How capable are they of replacing, and in some form, that X factor leadership energy and guidance and things like that in the business to make sure the sausage machine keeps rolling. Okay, all that creates risk. If the owner is only in the business once a month and he's able to take holidays for 2 months a year, we're pretty comfortable. If he's in the business 10 hours a day, we're very uncomfortable, and that needs to be mitigated, and it creates risks. There are also other risks, things like key vendors that you have. What happens if you have one vendor that's supplying most of your products and they decide not to supply to you? Things like that. Capital refresh can be another one. If you have a capital intensive business and you have a lot of old equipment that's suddenly going to need to be refreshed, that's going to take a drain on the profit. And that needs to be examined. That's more of a hit on EBITDA than anything, but it can create risk. Okay, so basically what we're going to do is figure out what your normalized or your adjusted EBITDA is. We're going to figure out what the multiple is. And like I said, generally between, under £1 million, it's a 3 or 4, and then we get into 5s and 6s. We have all kinds of data that tells us what other companies have sold for and what their multiples were. But what I always tell people is that this is the start of a conversation, right, on valuation. That's the beginning. The middle of the conversation is a lot of different things that are specific to that company and that particular buyer. How the customers are going to take to the business being sold, how the employees are going to be, all kinds of things go into being comfortable with the risk factor and all that. And so it ends up becoming a conversation, and also just expectations of the two parties. So there's a discussion. So the starting point is the math. Then there's a discussion using the math. And then the third aspect, the end of the conversation, is actually cash flowing. The actual sale has to cash flow. And this is the part people forget, that when the buyer buys the business, they're only going to have a certain amount of money. Unless they're private equity, usually they're going to be borrowing money. Most businesses are bought with some kind of debt. Think of buy-to-let flats, it's the same thing. And there's also a certain aspect of deferred payments. We get into deferred payments and how you protect them in another video. And all of that creates a cash requirement for the business to have to pay the bank for this debt, to have to pay the deferred payments. And if that ends up being more than the actual profit, the house of cards comes tumbling down and it doesn't cash flow. So we start off with multiples. In the middle, we have a discussion that's more nuanced for that specific business. And then in the end, we look at whether it's going to cash flow or not. And the other thing to understand is that business sales in the end are never just a number. So now we've got a nice number that we call enterprise value that says, there's this multiple times this adjusted EBITDA, and we think it can cash flow. But now we need deal structure, because if someone comes along and says to you, I'll give you all cash for your business, which is unusual, by the way, we call those unicorns, then most people will take less enterprise value because it lowers their risk. If someone comes along and you love the buyer, they're perfect for the business, but they only have enough to give you a 40% closing payment and they can't borrow any money and 60% is going to be deferred, you're probably going to want a bigger number that you're going to get paid overall, because to compensate for your risk. So deals are sort of like a wedding cake. The first layer of the cake is the closing payment. How much am I going to get at closing? And closing payment generally is a combination of the funds that the buyer has and the debt they're able to get. We're going to add on to that excess cash, which I'll come to in a moment. The next layer of the wedding cake is the deferred payments. How much am I going to get, on a quarterly basis, and when, as the business makes profits? The next layer on the cake is earnout. So far, when I take the closing payment plus deferred, and remember, deferred is like debt. I always say deferred and debt start with a D, okay? And that becomes that deferred plus your closing payment becomes what that number calculated to, the multiple times the adjusted EBITDA. But sometimes people have a situation where they're like, this isn't fair because I've worked on a contract for 2 years. It hasn't produced any money, but it's about to produce a lot of profit. It's sort of like an asset, but it's not manifesting mathematically. And so we have a third layer of the wedding cake called earnout, where we can say, you know what, we believe you, and when that revenue comes in, we're going to give you a big piece of that. We do things like you can have 75% of the profit from that contract in year 1, 50% in year 2, 25% in year 3. I'm giving you an example. There's lots of things you can do. Deal structures have lots of components. The other component, sort of the very top of the wedding cake, is any consultancy payments that are going to go to the sellers after the fact. They may stay in the business, and there's lots of things we can do with that. We can structure lots of different payments that we may not be able to do in the main deal structure. Sometimes the bank is demanding deal structure be a certain way, but we want to give the seller more money, and we can structure that in consultancy payments. So there's a lot of moving parts to this. Now, just to move on to excess cash. Now, a lot of times people have more cash in the business than the business needs to operate. But it really isn't just cash. It's a number we call working capital. And working capital is really cash plus debtors plus stock minus your short-term creditors. So it's minus your trade creditors, your VAT, and those kind of things, and any corporation tax that's due, although that tends to fall into a long-term debt category. So basically what happens is that the business, as it makes profit, that working capital figure goes up. And so it manifests, your profits manifest in your bank account getting bigger. Anybody that's been in business will know this. The business needs a certain amount of that working capital to operate. It needs a certain amount of cash in the bank, is the layman's way we put it. But it's mathematically a bit more than that, because if you have a month where a lot of your debtors haven't paid, your cash balance will be lower, but you know it's going to sort itself out because the debtors are coming in. Same thing in reverse on your trade creditors. If you haven't paid your trade creditors, your bank balance can go up. So we like to look at all those in conjunction with each other. But in effect, there will be a number where you have cash that's surplus to requirements, and the reason it's surplus is that's your hard-earned profit that you haven't taken out of the business in dividends. Well, a business sale often is an ideal opportunity to take that cash out, because what we can do is we can take that enterprise value we calculated, we can actually add the excess cash on top of it to increase the sale price, and then that cash is distributed to you at closing. And then the whole thing is you're paying capital gains tax rates rather than dividend rates. These are just some things that we've seen done in the past. Again, you would always want to check with your accountant and your tax advisor on whether this is applicable in your specific situation. The same thing with property in the company. Properties can take on different flavors. If you have a property that's the office, well, that's actually being used by the business. It can oftentimes be included as one of the assets, just like any other machine or something like that. But often the property is way, way more valuable. And so the seller may choose to demerge that property into another limited company and charge rent to the company. Unfortunately, that rent will lower that adjusted EBITDA number in the valuation, but then the owner's getting the rent after the fact. But in effect, the owner has a choice about what he does with real property. If you have things like Ferraris, or I'm just using a facetious example, but assets you brought that aren't used in operations, again, all that is profit that you've used to buy that Ferrari. And so it belongs to you. Anything that's done in the past belongs to you. And in normal situations, you should get to take it out. These are just the overall concepts. Deals have all kinds of different ways that we construct them, but that's the basics of how you get to business valuation. Great, so we hope this has been helpful. We designed this series specifically for new business sellers to help educate them on the process and deal intelligently with advisors and things like that, and just have a better journey with it. If this has been helpful, we've got more videos in the series. You can subscribe. I've also written a book called Selling Your Business, which is specifically designed for people that are new to the selling process. It's 18 chapters. Chapter 4 is actually on the topic we discussed today. If you'd like, we've created a nice flip version. You can see a link in the description below, and we'd be happy to give you a paper copy as well.